Welcome to the Big Biz Show. Taking care of business. You want fast-talking, hard-hitting discussions on business and finance? Maybe with a barroom slant and some really salty peanuts? We're not counting calories. We're counting cash. Before we get to the man with the financial plan, meet the money team. Costa, Mary, now Captain Finance himself, Sully.
What's going on, everybody? Welcome to another episode of the Big Biz Show. We're live inside the Loft 100 studios here in Southern California. Oh, Southern California, you might ask? Yes. This is where we say, no, it's not. It's not what we say. Every time you see somebody new, that's the Day Tater Trio. Costa, Mary, Godwin, and Sully. Hey, buddy.
Were you born here?
Yes, I was.
In San Diego?
Yep.
I was
Native.
born and raised.
So was I.
So
was James.
Brian, too? What about you, Trace?
Trace, you?
No, I was born in Michigan.
Oh.
Ferner.
I know.
He's a Ferner.
Burner.
Boy, hallelujah, shutdown's over. Here's Howie Font to talk about that. Government shutdown ended yesterday, late.
Yes.
Or I should say.
But how long is it going to take to bounce back? Is that what Howie's going to tell us?
Howie, did they kick the can down the road a few months like they normally do? Just because this is wag the dog to me. I think everyone sort of knows it's going to end and just miraculously ends right before Thanksgiving, because if it didn't end before Thanksgiving, it was going to go till December 31st, right? So talk about this a little bit, because
I mean, there's a reason these things haven't gone that long, to be fair, and I think that this went longer than anyone wanted it to. And there are going to be real consequences still. I mean, you have air traffic controllers that didn't get paid for 40 days that, were just on the brink. The Trump administration put out via tweet or truth or whatever that they want to pay those guys $10K, but also they cannot take off because a lot of these guys want to now stop doing double shifts and they want some people that quit to come back. So we could still see some delays, and I think there is permanent damage from too long of a shutdown that was longer than people expected.
Well, so there was almost 1 million federal workers, about 900,000 federal workers furloughed. Those guys are all coming back now?
Yep, everyone's coming back. Everyone will get back pay. It takes a couple months for the government to sort through that. That's another thing. And there's work that needs to be done on a monthly basis or so. That's just, we're not going to have, there's a bunch of data that's always collected that wasn't collected in October. We'll never have it. So
yeah. And Howie, one of those things that I think, what's her name? The White House Carolyn Leavitt, is that her last name?
Yeah.
She said something about it's either the jobs number or the inflation number or something won't be coming out.
Both. Yeah, we probably won't get either of those.
Okay.
Yeah. I mean, these are important indicators for the market, and ironically.
Well, but keep in mind, Howie, because this was the longest. The last government shutdown, if I'm not mistaken, was 35 days. This one was 43, 44 days, the longest in history. But it's the aftermath effects. I mean, look, you're going to see a bump in the market. You're going to see a little Santa Claus rally before Santa Claus comes, like we always do. So we're going to see a little spike. We'll see some volatility. See another spike at the end of the year. Then we'll see tax loss selling. That's what's going to happen in the stock market for the next 5 weeks. However, the economic impact is long-lasting and not to the positive side, right?
Yeah, I mean, I think that I gave you guys some estimates about some of the damage. That we have a 27, I think, $1 trillion economy. I could be a little low on that number, but we lost about 15 billion a week during this shutdown, as far as annual GDP. So small in the grand scheme of things, but needless when you see what actually
that just tells
happened.
you, though,
none of this needed to happen. It was just
that just tells you how much of our economy is government people.
Well, that is true, by the way. I mean, government spending.
If you think about the billions, if that's how much money we lost in productivity and gross domestic product, which is the report card of our economy, if we lost 15 billion per week in GDP because of a government shutdown, doesn't that tell you a much bigger picture? How much money the government is taking and frankly contributing to GDP? But I would love to know the percentage number of all workers that work for the government. I think it's up to almost 20% now in this country.
Yeah, I think if you take the number of people in the government that work for the government and the number of people that are paid via government contracts,
right,
it's something like, I want to say the numbers in the mid 40s as far as the the annualized income of people or the annualized business that happens in the country. So it's a huge. I mean, let's not underestimate the federal government. It's the largest organization on the planet.
It's true. You know, the other thing too, what's interesting is you think about, for example, when you see a Hollywood movie strike. You don't think about the deli on the corner that feeds all the people at lunchtime,
right?
Or the food trucks, or all the ancillary economies, the dry cleaners around there. Not just the movie stars, but the people that work in the businesses. It's really cyclical. Even when they built Staples Center in the middle of a really low-income neighborhood in Los Angeles. If you take concentric circles outside, property values have come up because of that. Same thing here, though, with the airport shutdowns. One thing people don't realize is you had air traffic controllers that were working 15-hour days. So now, just because airlines are back, you got airline controller fatigue, right, Howie? I mean, it's not going to be overnight that the airline, right? That's not going to be fixed overnight. And then you got backlog and
what about all the flights that were canceled?
You got backlogged.
Yeah.
You got backlogged. And you've got, how's the morale with the air traffic workers over there? I mean,
thank God that's not a stressful job.
I heard two things. I heard, and this is coming from their union rep, so take that with a grain of salt. But I saw an CNBC interview where they said, they have a long lead time on their training program, and a bunch of the incoming trainee air traffic controllers are saying, this isn't the career I want. No, thank you. This can happen randomly. I'm not going to deal with not getting paid for 2 months. That's ridiculous.
Yeah, it's a little scary.
We lost some new people.
How confident are you that the government is going to get the budget thing figured out so there's not a shutdown, so we don't look at this again? Because I don't know what the deadline is for having a balanced budget again, but I don't think it's again. I don't think it's next December. I think it's got to be sometime in the first or second quarter, correct?
It's in January.
Yeah, okay. So we kicked out there on 7 weeks. It's a 7-week deal. So just like many of us have learned so much from the Great Recession, including the mortgage industry, how much did government learn from this one? Anything at all, you think? Or do you think things will be different come January?
No, I think this was political haggling that just couldn't get there. I think you could learn a lot about negotiation and payoff tables and how to get to yes from watching this or from maybe dissecting this. But I think some wrong moves were made and people were stuck in their positions, and it does do damage to the economy is kind of my point today. And then ironically, we talked about the shutdown the last few weeks and how the economy the market was just kind of ignoring it. Now we have the market finally thinking about all of the money they're spending on AI, and that's actually bringing the market down. So for different reasons than the market's coming, than the shutdown coming back, the market's down.
Well, here's the good news. Things are not as bad as you think. They were the last time the country was not in debt was under Andrew Jackson, which I believe was 1835. Oh, so we've been in debt the whole time. So this is not a new thing. So it's not horrible. Hey, I got 30 seconds here. Are you in agreement with me that we see a bump here in the market, then some volatility, then we'll see a Santa Claus rally, then we, of course, every year we get the tax loss selling? Or do you think it's going to be blue skies from here?
No, I think all those things happen. I just wonder if in a year with such large gains, especially in such few companies, the Mag 7, NVIDIA, all that, I think we see tax loss harvesting a little bit earlier. We're at 6,800 on the S&P. I think we could go to 7,000 by the end of the year. A little above 7,000 by the end of the year is reasonable. So we've got a little bit more to go, but there's also going to be that tax loss harvesting selling.
You either feel smarter after Howie or less than. I can't decide.
I feel smarter, but I also get really depressed sometimes.
Thanks, buddy.
Howie Font, Big Biz Show market analyst. Always great to have him along. Always great to have you as well. Keep it right here. Much more to come with the Big Biz Show. Do not go anywhere. Big Biz Show continues. Hope you guys are having a great day. We always appreciate you being along with us here inside the Loft 100 studios in sunny Southern California. The Day Trader Trio is always with us as well. And back here at the bar, it is Costa, it's Marybird Godwin, and it is Sully.
Great to have you along today. Let's get right to it. One of our favorite guests, Corey Pearlman, social media keynote speaker, CoreyPearlman.com, impactsocialmedia.com. Hey, have you guys heard this thing called the half tuck?
Yes.
Is it
now it's on the side. Instead of doing it in the middle, you do it on the side.
Because I got accused of it the other day. It wasn't on purpose. It was like I drank a big thirsty 2 ouncer, went back, was like, hey guys, are you guys ready to go to the show?
No, this is the thing.
Sully's adopting the half tuck.
I learned about it on social media.
I did it. I used to, when we went on TV,
Yeah.
I just go, hey, okay, instead of doing the whole thing, say, hey, a Big Biz Show, Big Biz Show. Look at the camera. It looks like I have my shirt tucked in.
Yeah.
Okay, so the half,
But you know
like
what?
one side?
It's business in the
I
front,
see what you're saying.
party in the
Party
back.
in the rear, exactly.
Right? Just like, now, that's,
Is it like the 6
no,
and 7?
it's not like
That's
that.
what I did. I did that yesterday.
What's that?
I did that on purpose yesterday.
Well, that's why you look so great. Your hands look so much smaller yesterday, Mary. Corey Pearlman is our guest today, one of Mary's favorites, and of course, digital marketing keynote speaker, and has taught us about all things social media. But there is a thing I believe what we're going to talk about today, audience fatigue, happened to Facebook in a certain audience segment and never came back. And it's happened to me where, thank goodness I have Mary to do. I mean, many of the things I find out in my life are because someone else said, hey, great thing on social, and it was because Mary put it up there. I go, I didn't know we did that. But I think this audience fatigue is also participation fatigue. Talk about that, Corey. Great to have you again.
Yeah, great to see you guys as well. And Mary's one of my favorite people too, so the feeling's mutual. You're welcome. Yeah, it's bottom line is I had a client one time who did a big piece of business with us, and she said, I've been following you for years. And I said, well, why haven't you said anything? She said, oh, I never will. I just lurk. And I remember her using that term, lurk. Yep, and 90% of our audience are lurkers. And so it's a good reminder for businesses that, although engagement is important, it's not the end all be all, and people are watching. And the last stat I'll share with you real quick is 1% of people on Instagram on average engage with posts.
Really?
Really?
Damn.
So, Mike, does that sound familiar for our program directors back in the day doing talk radio?
Oh my gosh.
So when Mike and I were doing talk radio together and separately for many, many years, I mean, you were doing morning show and I was doing afternoon drive talk radio, the program director would tell us all the time, the callers are not your audience.
Nope.
The callers represent 1%. Just because your phone lines are full doesn't mean jack.
Or don't get scared if the phone lines don't ring.
Or don't get scared if the phone lines don't ring at the same time. Now, Corey, having said that, what is audience fatigue, though? What does that mean? Do we have a soundbite for that? I understand. We got something that we're going to play in the background? Oh, maybe not.
Cool.
Maybe I'm getting.
I can tell you what audience fatigue is. It's what's happening. Exactly what you said has happened on Facebook is also happening on all over social media. The more noise that's out there, the more tired we get, and the less likely we are to communicate or engage on stuff that we're looking at. So it's just important for businesses to remember that things like saves and messaging, those aren't tracked on those engagement metrics. So it might be working even though you don't see likes, comments, and shares.
So here's a perfect example of this. Our band got on a big ticket we went to Louisville Bourbon and Beyond Festival. Okay, and what was there? Maybe 300 people in front of our stage, which is not the thousands, but it was pretty good. And the funny part was we only have 8,000 people following us on Instagram, and you see lesser bands and lesser famed people, but we're watching people singing our lyrics back to us and literally going, okay, there's no way. How is this happening? That's a great example of the fact that people are watching. Why is it so important for us? And why is the measure the number of followers and engagement, like Mary's always said? Why is it that? And why shouldn't it be, in reality, why shouldn't it be tracked like Arbitron and Nielsen, through statistics? Because look, in the city of San Diego, there are what they call PPMs, personal people monitors, for all the radio stations. And they take this is a city of 3 million people, and I think there's 150 of these things that go around that are supposed to statistically tell you what people are watching and listening. There's got to be a way to do that online now, because that should be what matters. Because we're dealing with bad information, aren't we?
The robots tell you. The AI bots tell you what's.
How do we know if that isn't the thing, Corey? What is the thing that we can actually measure?
This is the other thing that'll blow your audience's mind when it comes to business. This is out of LinkedIn. A man named Richard Vanderbaum gave me this data, but your super fans, the ones that comment all the time, their conversions for you are 0.4%. The silent stalkers who never engage publicly, 12.8%.
Jeez.
Whoa. Okay, Corey, how does this work with the whole, I feel like there's been a big algorithm shift in the last, I don't know how many months, but now I'll see a few posts from the people I follow and my friends, and then I get a couple from, what they think I'm gonna like, and it says follow in the top corner. I'm getting served maybe 50% posts that of people I don't even follow, and I will engage, and I'll engage multiple times.
Because it's new. Because it's new. You think?
Well, Instagram knows that I like this type of content. I might even have forgotten to follow them. I thought I was following them because they come in my feed so often. So this goes to your point that, the followers number doesn't really mean that much anymore. It's content that is engaging. Right?
And what it tells me is there needs to be a metric that we can use in business to know, because many people are using Instagram to determine how much they're going to pay you for advertising, or determine whether they want to use you for influencing this or that. There's got to be a better way, right?
Right. And to Mary's point, adjacent content is coming up more than stuff that you're actually following. And the thing that businesses need to track more than engagement numbers are conversions. So for example, DMs. That's why I always recommend businesses ask clients to DM you, because at the end of the day, that's how you get the conversation started, and that's how business is done.
Are any of the social media platforms, LinkedIn, Facebook, and Instagram, or even Spotify, working on a better mousetrap? Because I can tell you, in terrestrial television, Nielsen, and terrestrial radio, Arbitron, they have not fixed the mousetrap yet. I remember we used to have in radio, you used to hear a time check, 24 past the hour, News Radio 600 Kogo. The reason you did it is so when people got their diary, they knew that they were listening to AM 600 Kogo at 24 past the hour, because that was a question. Mm-hmm. When they finally got the digital DNA back versus what people were in, they were wrong literally 98% of the time. And for years and years and years, all that advertising was based on false information. Same thing's happening here. There's got to be a 2.0 in terms of that. Is that coming? Are those platforms working on that or not?
I got good news, bad news for you. The bad news is I'm not sure that will ever happen, where people will honestly be able to see the metrics that are equating to whether or not it's working or business is being done. But the good news is, if you put a clear call to action in your content of what you want people to do, you will be able to see if your content's working. If it's share, then you'll see how many shares you get. If it saves. And of course, if it's call to action, click to the website, whatever, that's what you should be tracking.
My advertising professor at San Diego State University, John Lettingham, where we won the National Student Advertising Association contest, would say, show your audience, and if you don't have a call to action in even your notes, you're going to get an F this season. So that's how that works. Pearlman, get in here. We're hanging out.
Corey Pearlman, social media keynote speaker, owner of Impact Social Media Inc., Pearlman.com and ImpactSocialMedia.com as well. All right, do not go anywhere. Lots more to come your way as the Big Biz. Whoever you're watching, we always thank you for being with us. The Day Trader Trio, those guys up there on stage, they're always with us. Costa, Maribor, Godwin, and Sully, always with you as well.
We're always excited to look at FDA advances and commercialization for drugs that are going to save our lives, especially when the word cardio is in it, Mike. Just telling you.
He looks right at me.
Jim Joyce, CEO, inventor of Sigyn Therapeutics, is with us in studio, SIGY. Can you remind our listeners what exactly the disease is and what you guys are doing? Because this is some pretty exciting stuff.
Well, Sully, we developed a device that has the capability, and this is a first in industry capability, to address a wide range of pathogens, bacterial toxins, pro-inflammatory cytokines, but also factors associated with cardiovascular disease. And by having this broad spectrum capability, we have an opportunity with our lead product, cardiodialysis, which is a dialysis-like product, to treat cardiovascular disease and have a commercial opportunity, an early opportunity in dialysis patients.
This is a blood purification, blood filtering system. To put it in layman's terms, is that correct?
That's correct.
When I start hearing that, I mean, this is to address cardiovascular disease, but I start hearing that, I start thinking about other applications. In terms of, I mean, if you could resolve or at least assist in cardiovascular disease by doing a blood purification, there's a lot of other things that have to be on in the future. Is there any, when you guys are developing this, is that in the back of your mind the whole time?
Absolutely, and that's an astute observation. But, this is an investment show.
Sure.
So people need to understand that
that's down the road.
That companies have an actual clinical strategy to get themselves across the goal. So cardiovascular disease is a unique opportunity for us because there is an FDA-approved precedent that demonstrates blood purification can have a major impact in reducing what are known as major adverse cardiovascular events in patients. And in fact, reducing these events far greater than any of the drugs approved in the marketplace. So we have a precedent pathway, but we also have a pathway where there's a broad commercialization infrastructure in place. What's been limiting blood purification therapies previously is their delivery has been limited to specialized machines that are located in apheresis centers. So for example, in the United States, blood purification for cardiovascular disease is limited to 54 locations. Whereas our device, we designed it for dialysis machines. What that means is there's about 100
plug and play.
That's right, 150,000 dialysis machines located at more than 7,500 dialysis clinics across the U.S. alone. So we have an infrastructure in place to ramp up large-scale commercialization upon approval.
Walk us through what a patient goes through during blood purification. Where do they go? How long does it take? What is the recovery time? And then of course, expected outcome time.
Yeah, so I can only tell you based on current approved products.
Sure. They
come in about every 1 to 2 weeks for 2 to 3 hours of treatment.
Okay.
And the current products are designed to reduce LDL-C, which is the focal point of Lipitor, Crestor, and other statin drugs, and lipoprotein A, which is not addressed with a drug therapy. And we're coming at this aiming to address LDL-C, lipoprotein A, but then a broad range of inflammatory factors that really fuel the progression of cardiovascular disease.
Who are the candidates for this? Is it someone that's already had a heart attack or some sort of episode, or someone that maybe it's in their family? And what do you look for?
Yes, it's certainly people with congenital disposition to suffer from cardiovascular disease, to not be responsive to current drugs. That's certainly an important indication. But our lead opportunity is in dialysis patients, of which there's approximately 550,000 dialysis patients in the United States. And these individuals, they generally aren't dying from kidney failure. About 67% of dialysis patients die from cardiovascular disease.
Wow.
So we have the ability, they're sitting in their seats 3 times a week, 4 hours of treatment. Based on the design of our device, it can incorporate in series with their normal dialysis treatments, so nothing changes for the patient.
Is this preventative by nature, or is this reactive by nature? In other words, can you, if you have the genetics and you know that you're probably leading down that road, if both fathers died, both grandfathers died, both fathers died of heart disease, and you're sort of predisposed.
Yes.
When you ask, does that person qualify for this type of treatment, or is it after they've sort of gone down the road of heart disease?
No, they're certainly a candidate, but it's we're seeing an emergence of these types of technologies, and if you look at the downstream applications, you referenced earlier opportunities, which we also see as secondary opportunities with life-threatening pathogen-induced inflammatory conditions such as sepsis. But if you look downstream at what's going on in blood purification, there's a significant push for these types of technologies to be involved with the anti-aging process, to remove the accumulation of toxins and other things that are circulating.
Well, I mean, look, I forget who the influencer is. It isn't David Sinclair. It's not Peter Attia. It's another one that is literally doing blood filtering, and he literally does like 20 years younger than.
Yeah, and it's but it's highly inefficient what they're doing. What they're doing is therapeutic apheresis, where they're replacing, it's called plasma exchange.
Right.
So he's probably spending $15,000 of treatment to replace his plasma, to remove his plasma, which is not necessarily that efficient, highly expensive. And if a technology is designed correctly, it can be very effective in removing these same types of toxins without needing any replacement fluids, without needing to take your entire plasma volume and then replace it.
There is a huge, large market opportunity for this. Talk about some of the news in terms of moving towards commercialization, because it really is an interesting sort of turn of events of what's happened here lately.
Yeah, so, I mean, our first and foremost, our primary focus is to execute on this unique opportunity we have in dialysis patients. And these are unique patients. And if we're successful with that opportunity, then there's the potential, if you can envision this, there's a potential to transform dialysis clinics, in the future into being renal and cardiovascular disease.
What's it take to get there for you as a company? What's it take for FDA needs to move quicker? Is it really coming down the arc of the story for the FDA?
No. It's really been defining the appropriate clinical pathway that's most executable. And these, I've been involved with the development of extracorporeal blood purification therapies for a number of years, and have seen firsthand experience that they can be life-saving therapies. And we've previously created first-in-industry developments that have done so. But from a regulatory standpoint, the challenge historically has been getting these products across the goal. And in many cases for life-threatening conditions, you have to enroll patients in an intensive care unit setting in a hospital.
Yeah.
And that's an immense challenge for any company to achieve. Whereas what we're doing with cardiovascular disease, with the initial indication in dialysis patients, we're enrolling dialysis patients in a feasibility study and then a pivotal efficacy study for approval. We never leave the dialysis clinic.
Right.
The staff knows their patients.
This needs to be at the front of the line for FDA, in my opinion.
Good Lord.
Right? I mean, this needs to go the way of the vaccines did during COVID, where they skipped the line to where they were looked at first. I mean, that's got to be next for you guys. There's got to be some sort of political will to get it there, because heart disease, again, #1 killer, right?
#1 cause of death globally.
Yeah. This is his name's Jim Joyce. Unbelievable.
CEO, Sigyn Therapeutics.
You come back often. It makes me feel better.
SIGY. Thanks, Jim. Loft 100 Studios, the Big Biz Show, and our affiliates and our hosts are not registered investment advisors or broker-dealers.
Our show hosts make no commitment that the purchase of securities of companies profiled or otherwise mentioned in our programming
are suitable or advisable for any person, or that an investment in such securities will be profitable in general.
Given the nature of the company's profile and the lack of an active trading market for the securities, investing is highly speculative and carries a certain high degree of risk.
We profile selected publicly traded and privately held companies on our program.
Most of these companies that we profile have provided compensation to Loft 100 Studios and its hosts for the profile coverage.
From time to time, we sell shares of the companies profiled in the open market that we receive as compensation for coverage of client companies.
But never sell stocks if we are speaking about interviewing or covering a public company who has paid compensation.
Specific questions on compensation can be obtained by contacting producer at sullyandgroup.com.
Listeners should verify all claims and do their own due diligence before investing in any securities mentioned on this program.
Investing in securities is speculative and carries a high degree of risk.
We encourage our investors to invest carefully and read the investor information available at the websites on the
Securities and Exchange Commission at sec.gov and or the Financial Industry Regulatory Authority, FINRA, at www.finra.org.
It is the Big Biz Show, live from the Loft 100 Studios. Those studios in beautiful, sunny Southern California. Always beautiful, too, to have the Day Trader Trio along. Beautiful to have me as well. Costa, Barry Godwin, and of course, Sully. Great to have you along today. And now for some bad news. Patrick DeHaan from GasBuddy.
Great.
No, I want him to have good news for us.
GasBuddy.com, we've been interviewing for the better part of a decade because they have a gas price temperature map that shows you across the country the average price per gallon of is it regular gasoline, Patrick? Am I accurate there?
It is. It's always beat red.
We're flaming hot on
Well, I mean, it used because the color codes used to be red, green, and yellow.
Yeah.
And now I think it's a little bit different.
Red,
in fact,
light
we,
red.
we can maybe our guys in the control can pull it up. But see, now it's purple and yellow's the worst. but it used to always be beet red. And
Sunshine.
And the average price per gallon in California is $4.11. But you can't find it if you're in any major metro, right?
No.
Where is it? But I have to ask this every time I talk to you. What's the cheapest gas in the country right now?
It's in Texas. Some stations within 10 cents of hitting that sub $2 price. And by the way, on that key, California is just so on top of it. It says greater than 411, but the statewide average is indeed much more painful. 467 for the statewide average. But yeah, I mean, last few weeks, Colorado, Texas, and I believe a station in Oklahoma briefly went below $2, but there's nobody below that number now. I think the cheapest is about $2.09.
Hey, Mike, let's do like we did in college. Let's drive 4 hours to save 3 cents in gas because we get it cheaper. We're driving to Texas to fill up.
Drive across the border to recycle the 10 cents on those beer bottles.
Actually, but I'm giving you guys a hard time because actually gas has fallen about 6.5 cents. Is it actually going in the right direction finally?
It is, and that's why the good news, bring me on this time of year, gas prices generally decline. Thankfully, California is going along with it, at least for now, so don't say that too loud. We don't want to give them any reason to start raising prices back up. California in the last week, down 3 cents a gallon. I will say that will accelerate here over the next week or two as we get closer to Thanksgiving. Of course, I always talk in caveats. I don't know what the future holds. I know you're really disappointed that I can't tell you if there's going to be refinery issues, but there's actually been an improvement to the refining issues that have caused California's prices to hover near that $5 mark. And so prices should be going down into Thanksgiving and possibly even lasting into a good part of December as well.
Patrick, what about drilling off the coast of California? President Trump has recently said, he wants more drilling off the coast of California. Governor Newsom has said, nah, it's not going to happen. How much does that affect it?
Probably not a whole lot. I think nobody's even really proven that there's any oil out there that's recoverable. So that's number one. But number two, the optics, right, of Newsom saying this isn't going to happen, that doesn't reassure the oil sector. I mean, the thing now is California needs oil for its refineries, whether that comes from overseas or where it comes from. I'm not necessarily going to argue and say we need to drill out in the California coastline. Having said that, there's definitely ways that Newsom could roll back the anti-oil rhetoric that we've been seeing and get some more affordable California gas prices here. And that's just one part of it.
I'm looking at the gas price temperature map here, and I'm seeing Pennsylvania has some spots that are sort of yellow. What would cause a state like Pennsylvania and that whole region, beginning in the Midwest and Chicago and Indiana and Kentucky and such, to have gas prices that increase a bit, and then only to have the East Coast be sort of moderate?
Well, you look at Pennsylvania, and again, to your point on the map, the entire West Coast, you can see it behind me is a little red in Pennsylvania as well. And a lot of that is what Californians know very well. State gasoline taxes amount to a significant part of what Californians pay. And that's also Pennsylvania. Pennsylvania is just behind California for the most expensive gasoline taxes. Same with Illinois. You'll notice all the states around Illinois are not red. We are. So a lot of what you see state to state has to do with gasoline taxes. And there you go. Western Pennsylvania has kind of a unique position of kind of being at the end of two pipelines that flow east to west, end up in Pittsburgh, and pipelines that flow west to east end up in Pittsburgh. So there's less competition in that Pittsburgh market, plus Pennsylvania's very high gasoline taxes. And then Illinois, our high gasoline taxes. And then looking out west, high gasoline taxes are just the start of the story in the West Coast.
I have to say, I say this all the time, that when you see gas stations increase their prices and folks are honking and getting mad, look, they're not making money on gas. They're making money on chips and soda. And I guess the question is how do these gas stations stay profitable? Because you can only tax more from a Funyuns, because of Slim Jim's, Red Bull, and Funyuns. Yeah. Yep. But honestly, it really is being passed down. And keep in mind, this is the other piece of this too that you have to understand. Increasing the price of oil does not necessarily coincide with an immediate increase in gas prices any more than increasing the price of a potato would increase the price of French fries. It's a commodity. Potatoes are a commodity to McDonald's. Oil is a commodity to Chevron. Okay, it's competition that'll move prices up and down along with these market factors. So how do these Chevrons, AMPMs of the world, although I think I know, stay profitable? It's got to be through the ancillary services, right?
Well, you're going to hate the answer here. Actually, California's probably got some of the most profitable gas stations in the country because you have cities that are putting limitations now.
Yeah,
on
that's right.
selling
That's a good
gasoline.
point.
So, there's a lot of folks in California, and margins tend to be a little higher because California has some really unique laws too that drive up the cost of doing business. So gas stations have to be more profitable because they have all these regulatory expenses. They have the highest minimum wage in the country. So keep in mind, stations have to be more profitable to pay the bills. And in California, a station might make 50 or 60 cents a gallon, but that 50 or 60 cents is getting gobbled away by high labor costs, high property taxes, all these local ordinances and regulations. So, there's a big chunk there, but a lot of it, to your point, gas stations aren't real profitable in California because all that margin gets soaked up and goes to all these different entities and different, laws and regulations and rules.
I think what's interesting for us is, and we talked about it, I think, on a previous show, is that when we were gassed about $3 gas, and then it's creeping $2.75, $3, and now it's $4, $4.50. We just get used to it after a while.
We spent a day bitching about it, and they were like, "No, all right, I gotta go somewhere."
Gas on the American public is a tax.
Yep.
Just like groceries is, because you don't have a choice. You need to drive to get to work. Patrick, as always, buddy, good to see you.
Patrick DeHaan, head of petroleum analysis, GasBuddy, GasBuddy.com.
I want to talk about that logo behind him next time. It says PDI. It's got to be Patrick DeHaan International.
Oh, look at
Patrick DeHaan.
Excuse me. Ahoy, boy.
I want to talk about that.
It's sort of cover the Big Biz Show. Don't go anywhere.
Listen, baby.
Wait, what?
Oh. It is the Big Biz Show. Wherever you're watching, wherever you're listening. We really appreciate the fact you're along for the ride. The Day Trader Trio always is along for the ride, as is Maribert Godwin and Sully.
How did you talk David Garofalo, my favorite mineral guest, to coming back? He is so busy, and he's also the CEO and chairman of a company called Gold Royalty Corp. On the New York Stock Exchange. Their stock symbol is GROY, but you must have. He literally is one of my favorite guests, and I know he got so darn busy because of all the things going on with the popularity of gold that we thought we'd beg you to.
Well, truth be told, I called him. I said, "Hey, can you just send me some gold?" And he's all,
"No, I'll just come on the air instead."
Who is this? Yeah,
David, great to see you again, man. How are you?
Gold.
Good. Listen. You. The best thing about David is he tells us something's going to happen in the market, and then it happens later.
Boom.
That doesn't happen often in this business, but I'll tell you we've got this surge in market optimism, which is usually counterintuitive to gold. But I'll tell you what, it seems like gold is not paying attention to anything right now other than moving in the right direction. Talk about what you guys do and talk about what's happening with gold overall.
Sure. Well, as far as gold overall goes, I mean, this is a long-dated play. This trade's been happening for 50 years. As long as the U.S. dollar has been debased and abandoned the gold standard, the value of the U.S. dollar has gone down and the value of gold's gone up. It's scarce. All hard assets have gone up. We've been in an inflationary cycle for 50 years, and gold is just an accurate barometer of that. And what we do in the royalty business is take a piece of the action at each and every mine site that we provide capital to. We take a piece of the gross revenue, and we're completely insulated from inflation that the operators are experiencing at the mine site, and we get the benefit of their exploration upside as they drill their deposits out. Our royalties extend to any growth that they achieve geologically on their deposits.
David, much like exploring space, it's so infinite. We'll never be able to, I think, in how many lifetimes say, "Oh yeah, we've got space covered." As far as the Earth and gold, has it been pretty much? I mean, you pretty much now know where the deposits are. Are there still some places where you're like, I don't know, there might be gold there?
Yeah, I know. I think the latter. The reality, though, is the sector has actually been starved of capital, believe it or not, for about 15 years, particularly the juniors that conduct all the heavy exploration. They're the ones that do it. It's not the established producers. They haven't had access to equity markets for at least a decade and a half. And as a result, the industry has actually seen their reserves in the ground shrink. Those are defined reserves. So the industry is cannibalizing itself. All the producers are merging with each other because if you're not finding it in the ground, you're going to have to replace it through consolidation, through M&A. And so that's really what's been happening in the sector. But that's a zero-sum game. If you think about it, when you cannibalize each other, you're not growing the pie at all. You're just depleting the pie more aggressively. And that means reserves are going down. There's been a remarkable inelasticity of supply and reserves to the increase in the gold price. So you're not going to see a supply-side response. That's going to add fuel to the fire in terms of how the gold price is going to behave from here on in.
You know, it's interesting because the reason you want to listen to David on not only his articulate is because he's in the gold royalty business. It is the highest part of the chain in the gold business. They're basically the finance companies for gold mines. So basically, it's a top-down mining industry sort of thing, and he's got to take a 50,000-foot view, not just a mining and mining tailings view or a manufacturing view. It's the whole thing. Talk about exactly what you guys are doing, because it's really interesting as a company what Gold Royalties does, because you're really at the tip of the spear, even more than miners are.
Yeah, we're like a bank, but we're singularly focused on the gold business. So we're providing capital to the explorers, the developers, and operators who otherwise can't access capital for a variety of reasons. And what we get in return is a royalty on their property, basically a gross revenue royalty. That, again, protects us entirely from operating costs and any capital costs at the mine site. So we're protected from inflation. So we provide unmitigated leverage to the gold price and unmitigated leverage to the exploration success of our operating partners, because as they conduct exploration on their properties, what they're incentivized to do to extend mine lives, to expand the production profile, we get the full benefit of that without actually having to contribute anything to their additional capital requirements.
Hey, David, you know, when you hear gold, you can't help but hear the word inflation, and because gold is a hedge against inflation. Sometimes it is, sometimes it is. But you and I talked about a year and a half ago when we first met through our good friend Trey Wasser through Ely Gold Royalties, who is a regular on this program and still a good friend. You mentioned that inflation is understated and interest rates are deeply different than what we think. Do you still feel that way at this point?
I do. I mean, is anybody experiencing single digit or 2 or 3% inflation in their daily lives? I know I'm not.
We just talked to Patrick DeHaan from GasBuddy.com, and we're here in the West Coast, we're used to $4.50, 60-cent gas. And when you and I started talking about this, we were getting used to $3 gas, if you think about it. So and although we always say the economy was turned off like a light switch and is going to come back like a sunrise, even though there's some rate cuts coming on, nobody's feeling this yet, correct?
No, that's exactly right. And another way to express this is, what about the purchasing power of your dollar? What's happened to that? You know, over 50 years since we abandoned the gold standard in the early 1970s, the dollar in 1971 is worth 1 cent today. In other words, we've lost 99% of our purchasing power, and that's irreversible. And it is irreversible because the central banks and the U.S. government in particular, they're going to have to continue to print money to get rid of the debt that they've strapped on. There's no conceivable and fiscally responsible way for them to repay the debt. So when you look at things like the big, beautiful bill, and I'm not trying to be political here, I'm just saying that's going to be hugely inflationary. There's going to be a significant amount of gas put on the fire in terms of driving down the purchasing power of our U.S. dollars.
What's interesting to me here is sort of how you stand out of all, what is it now, 265 or 260 gold royalty companies. You guys are really different. Talk about the difference between you and some other folks out there.
Yeah, so we have over 250 royalties in their portfolio with a heavy concentration in 3 of the 5 best jurisdictions in the world, Nevada, Quebec, and Ontario. Over 80% of our portfolio in those low political risk, highly geologically prospective jurisdictions as well. We have 360% growth from our portfolio over the next 5 years in the gold attributable to our royalties. So that's just the volume, not counting the increases in the gold price. That means we're going to see our EBITDA grow from about $15 to $20 million to tenfold over the next 5 years from the existing portfolio of assets. All of our royalties are bought and paid for, so that means all of that growth is organic with no additional capital required from our shareholders. So we're going to generate massive amounts of free cash flow in the next 5 years and talk about increasing and introducing dividends to our shareholders to reflect that significant growth. And it's on 3 of the 5 biggest producing gold mines in North America. So yes, we have a lot of royalties royalties, we have a lot of diversification in the portfolio, but we also have a foundational element to our portfolio with royalties on 3 of the 5 biggest producing gold mines with the longest lives in North America, with some of the biggest and best capitalized producers in the space.
Hey, I don't care how busy you are, you can't get out this time. We're not letting you away. We need you on a regular basis, man. I got to tell you. David Garofalo, Chairman, CEO, Gold Royalty Corporation. Their ticker symbol is GROY. And why I have to say this, I don't know, but it is the end of this edition of the Big Biz Show. Thank you for being along for the ride. We will see you next time.